The next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value, 1 basis point. What it means is that so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too.
The Federal Reserve is poised to leave its key interest rate unchanged Wednesday when the Fed faces an economy that has proved resilient but is under pressure from surging interest rates, overseas turmoil, and anxious investors. Federal Reserve Chairman Jerome Powell acknowledged recent signs of cooling inflation, but said Thursday that the central bank would be resolute in its commitment to its 2% mandate. In a widely anticipated speech delivered to the Economic Club of New York, Powell evaded committing to a specific policy path, but did not indicate that he was leaning toward a push higher for interest rates. According to economist Jim Rickards, interest rates have likely peaked and are expected to decrease. In the bond market, when interest rates decrease, bond prices tend to rise, but the extent of the price increase varies with the bond's maturity. Longer maturity bonds, such as the 10-year note, tend to experience more significant price fluctuations, making them more volatile in response to interest rate movements. This relationship is due to bond price sensitivity to interest rate changes, known as the dollar value of 1 basis point, DV01. Longer-term bonds tend to be more volatile in response to interest rate movements. Since late July, the yield or rate on the 10-year U.S. Treasury note has jumped from around 4% to about 4.8%, a 16-year high. The run-up in the yield has inflated other borrowing costs and raised the national average 30-year mortgage rate to 7.5%, according to Freddie Mac, a 23-year high. Jim sees that among U.S. Treasury securities, the highest yields are found in shorter-term securities, particularly 6-month bills. This is unusual, as longer maturity bonds typically offer higher yields to compensate for the added risks associated with a longer investment horizon. In the current market, 2-year notes provide a high yield, but with less volatility than 10-year notes. This makes 2-year notes an attractive option for investors looking for safety and a decent return. We will now present clips from Jim Rickards' interview with Paradigm Press. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all Treasury securities. But so I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly if a company's going to underperform. We're going to go into a recession. We're going to have you're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. But so we're talking about U.S. Treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but well, between 5.25% and 5.5% for 6 month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. So again, 10-year note is riskier from a market point of view, not risky from a credit point of view, good yield, and a lot of capital gains potential.
Official data released on Monday revealed that gross domestic product, GDP, expanded by 4.94% in the third quarter compared to a year ago, falling short of the 5% median estimate from analysts surveyed by Bloomberg. Furthermore, the economy exhibited a modest growth rate of 1.6% in the previous 3 months, also slightly below the survey's estimated 1.67%. Jim, an expert in economic analysis, foresees that the United States might be heading into a recession despite the recent surge in GDP growth, reaching 5% in the third quarter of 2023. He emphasizes that this growth heavily relied on consumption and inventory buildup, with the understanding that increased consumption contributes to GDP, just as inventory buildup does. However, an important factor to consider is the fate of this inventory. If it remains unsold, it ultimately leads to markdowns and sales aimed at clearing the excess stock, often prompting retailers to offer discounts and bundling promotions to attract buyers. The inventory situation is closely tied to consumer behavior. Notably, in August, consumer spending suddenly slowed down, possibly due to the reduction in government-issued pandemic stimulus checks. In 2020 and 2021, Trump and Biden implemented stimulus checks totaling $1,400 and $600 alongside other relief measures. However, by 2023, savings were depleted, and the savings rate fell from 13% to 3%. Many resorted to credit cards, accumulating high interest debt. Jim Rickards sees this credit card reliance as a potential factor in an upcoming recession. Let's get back to the interview.
The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff. But if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they'd done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were spending we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%.
In the near future, it's expected that the Federal Reserve will maintain its current interest rate, emphasizing its commitment to a robust economy amid rising interest rates and global uncertainties. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.